Sorry, we had a small internet issue. It seems like it's struggling at the moment. It was working fine before, so hopefully it's coming back. But that means that our internet problem is still not solved. Okay, so now it should be a lot better though. Yeah, we just need a bit to wait for the connection to stabilize. But well, okay, we're gonna skip this one. So normally now connection should be good. So yeah, basically what's like I've explained it several times, but in case you've missed it, upward trend is higher high and higher low, and downward trend is lower low and lower highs. And the rest of those the trend are basically called range, and a range is basically everything that's not either upward trend or a downward trend. Then now we are gonna go on Q&A because today there's no volatility, there's no need of trying to trade and just take a bad position because we feel pressure, we feel the live pressure. So it's gonna be like I've prepared like maybe 10, something like 10, 12 questions. So if you have any, don't hesitate to ask. So one of the question, the easiest question is what is a bull market, and then I'm going to talk about the bear market. But basically, a bull market is a prolonged period during which the price of a financial asset, like equity, index, cryptocurrency, stuff like that, rise steadily. In a bull market, it happens when investors are optimistic about the economy and the prospect of therefore they buy assets in the hope of future gain. It can be fueled by several factors, including low interest rate, accommodating monetary policy, strong corporate earning, good economic indicator, and they can last for months, years, but usually after a bull market, there tends to be a bear market. And a bear market then is a prolonged period during which the price of financial assets such as equity falls steadily. In a bear market, investors are pessimistic about the economy, and the prospect of growth and stuff like that. Therefore, they sell assets to avoid further loss. There are several factors that can trigger a bear market, like an economy in recession, a corporation that fail their earnings, geopolitical tension, unforeseen event like COVID-19, for example. It's pretty hard to navigate. Bear markets are harder to navigate because like price can fall rapidly. It can be difficult to predict when the market begins to recover. Hence, sometimes you can take short while the market has already started to recover. Or sometimes you take short and it's the day the market corrects and everything. So bear market tends to be a bit more difficult to navigate than bull market, and that's why, for example, there's this famous quote by Warren Buffett that is, it's when the sea withdraw that we see who's swimming without their swimming shorts. So another question is what's volatility? Because we speak a lot about volatility. We want to trade when there's volatility, but basically market volatility refers to the amplitude of price variation in financial assets over a given period. A highly volatile market will see large price fluctuation in a short space of time, while a low volatile market like today will see slower, more stable price movement. There can be many factors that cause volatility: economic or political event, company publication, change in interest rate, emotional reaction of investor. High volatility kind of offers higher opportunity for profit, but it also entails increased risk for investors and traders. What is the volatility index? The VIX. The volatility index, or mostly known as VIX, it's an indicator that measures the implied volatility of the S&P 500 index. It's often nicknamed the fear or the market fear index, as it generally rises when investors anticipate increased volatility or falling price of the stock market. It's basically calculated from the price of calls and puts of the S&P 500 index, and it reflects the market maker expectation of price fluctuation over a 30-day period. High VIX indicates a period of uncertainty or stress in the market, and a low VIX can be interpreted as the opposite, a period of stability or investor confidence. That's why also the VIX tend to rise when the market goes down and drop when the market goes up. What is liquidity in the financial market? Because that's also something that's quite important. That's why also we trade future and everything. It's because we want liquidity. Liquidity in the financial market, it's the ease at which financial asset can be bought or sold without affecting its price. Liquid market, in a liquid market, there's going to be a lot of active buyers and sellers, and that will allow to have rapid transaction at price close to those displayed. And in an illiquid market, on the other hand, when there's a limited number of participants, hence it can result in a widespread in buying and selling price. And if there's a bigger someone that wants to take a move, that want to have a big operation, they're going to affect heavily on the price. Liquidity is a very crucial aspect of financial market because it facilitates the conversion of assets into cash without disrupting the market. That's one of the problems that happened in the 2008 financial crisis, because Lehman Brothers had a lot of financial assets, but those assets were liquid, overvalued, and if Goldman Sachs, Lehman Brothers would sell those assets to the market, the price would drop a lot because they were not liquid, and it would then force them to book a massive loss to the point that led them to bankruptcy. Another thing that was a problem in Lehman Brothers financial crisis in 2008 was leverage. They were having 30 leverage of 30, so basically for one of their dollars they were exposed at 30, the equivalent of $30. And leverage, it's basically a tool that allows traders to increase their market exposure by borrowing funds. It enables a trader to control a larger position that he could afford with his fund. For example, let's take an example of a leverage of 1 for 10. If the trader has 1,000 euro, he borrows 9,000 euros, and then he can take position for 10,000 euros. But then if the position loses 10%, he's going to lose all of his money. And therefore, the broker or the person who lend him his money is going to want him to cut this position so that he don't lose the money that isn't his. That's what we call a margin call. And for that, before we talk about margin call, we're going to talk about what's margin and margin trading. Basically, margin it refers to the amount of money or asset that an investor must deposit with a broker to open a trading position. It's basically a security for the broker against potential loss. Like, for example, if you trade future, you don't need to have all the contract money in your wallet, in your broker account. You can have maybe a portion of it. That's margin. And margin trading, basically, it's you borrow money. It is that and you borrow money from a broker to buy or sell financial instruments, and the goal is to amplify potential results. But also it increases the risk. Obviously, if it works in one side, it works on the other. And you need to when you're using margin, you need to maintain a minimum balance, and it's called the maintenance margin. If you don't, if it goes below, they're going to close your position. Or if they don't close the position, and if it's not automatically closed, they're going to issue you a margin call, which will basically require you to either deposit more fund or close the position. So to give a better explanation, what's a margin call? A margin call occurs when a broker asks a trader to add a financial instrument, no fund, to his trading account to cover potential loss and maintain sufficient margin. As the trader position declines, so as the trader loses money, the fund in his account is probably going to may become insufficient to cover potential loss. Therefore, to avoid the forced liquidation of his position, the trader may be required to deposit additional funds in his account, which is called a margin call. Margin calls are common when a trader position suffers significant loss, and they're used to protect both the broker and the trader of excessive loss, because if there wasn't any margin call, you could lose way more money than you have, for example. And then we're going to talk a bit about market structure and how market function works. And the first thing we're going to talk about is efficient market. Basically, when we say the theory of efficient market by, I forgot the name, but I think it's something Sama. As we know, it's a theory, but an efficient market. But basically, what's an efficient market? It's a market where asset price quickly and accurately reflect all available and relevant information. And in a completely efficient market, it's difficult for investors to make excessive profit by using public information, since asset prices are already adjusted accordingly. There are several forms like weak, semi-strong, and strong. And basically, the more efficient is the market, the harder it is for traders to generate profit. That's why also it's becoming more and more harder and harder for retail investors to generate profit. Is because of the market tends to be more and more efficient. From that, we can extract some kind of law, which is the law of one price. It's the principle. It's also known as the principle of valuation. It's a key concept, and it stipulates that a financial asset should have a single market price that reflects all available information. We can see where it's coming from. If an asset is valued differently in different places at different place or different time, arbitrage opportunity would arise. There would be opportunity to buy an asset at a low price in one place and sell it at a high price somewhere else. And therefore, you would buy it at the low price, which would raise the price, and sell it at the high price, which would downward the price. And in the end, they would align across all markets. And it's a fundamental principle underlying the efficiency of financial market. What those two law and theory state is that it's impossible to do arbitrage actually in finance. And what's arbitrage? Arbitrage, it's a finance in finance. Basically it's a strategy that takes advantage of price difference for the same asset on different market or different time. Basically, they do what the law of white price say was not possible. And now, since the market were not always efficient, there was very often arbitrage opportunity. For example, a famous one lately, what we call the kimchi arbitrage, where Bitcoin in Korea and Japan were more expensive than in the US, and you could buy Bitcoin in the US and sell it in Korea and Japan, and continue again and again. And the law of one price is basically says they should converge. And now arbitrage are performed by computer algorithm. Therefore, they are not. It's very, very, very difficult for retail trader or trader that are not highly sophisticated to identify and execute arbitrage and arbitrage opportunity. And those arbitrageurs, the ones that actually have those computer algorithms, etc., play a very important role. I was going to say fundamental, but yeah, very important role because they maintain market efficiency by aligning price and limiting risk-free profit opportunity by taking them. And so now we have our last two questions, and after that we are going to end our live because there's not a lot of volatility, and on top of that we seem to have a pretty bad internet. So my last two questions were that we had were about fundamental and technical analysis, which are the two first steps of our trading routine. So fundamental analysis, it's a method of valuing financial assets by basically looking at all the fundamental factors that will affect the price. For example, if we look at currency, we are going to look at monetary policy, statistics, economic statistics, stuff like that. If we look at the general, like at index, we're going to look at general economy in a region. If we look at stock, we're going to look balance sheet, income statement, cash flow statement, business model, etc., etc. And fundamental analysis is basically the analysis of, like I said, all the fundamental factors that are driving the market direction. And then technical analysis, it's the study of price chart, volume, and technical indicator, and you use that to predict future market movement. And the theory behind technical analysis is that the history of price movement can provide clue to future move. There's several moves, but if we look at indicators, there's going to be like a moving average, a Bollinger Band, RSI, stuff. Otherwise, there's going to be the Japanese candlestick, and it's mostly and the shorter the time frame you're trading, the more technical analysis is important, and the longer the time frame you're trading is important, the more fundamental analysis is important. Well, thank you for everyone who bear with me during this live. Sorry for the poor quality. We're still gonna try to fix that for next time. Well, thanks. Don't hesitate to like and subscribe, hit the bell, turn the notification, and